Hi, it's Steve here to walk through our new TFSA Top-up feature. We're going to be using a sample projection today for John and Jane Snapper, who are currently 58 years old and looking to retire in 2 years' time. I'm currently on the combined planning page, and if I scroll to the right, we can see from their financial assets section that they're currently making contributions into their RSPs, and then they're withdrawing from their non-reg and registered accounts once they retire, in addition to receiving a defined benefit pension plan and their government benefits. You'll see right now there are no assumed contributions going into their tax-free savings account. We can use the new TFSA Top-up feature by going to Scenario Setup and then Assets, then clicking on the TFSA tab, and then we can click this button to maximize TFSA contributions for this scenario. You also have the option to use spousal resources if necessary. So this would just use Jane's accounts to contribute to John's if John has depleted his non-reg, and vice versa. If you only want to use each individual's assets to contribute to their own TFSAs, you would just uncheck this box. If we go back to the planning pages, we can start off by taking a look at John's plan and see the impact of those top-ups. So you'll see for the 2 years before retirement, Snap is automatically contributing $7,000 into the TFSA, and it's withdrawing money out of the non-registered accounts in order to fund those contributions. Now you'll see it withdraws slightly more than the $7,000 in this case because there are capital gains taxes payable on the withdrawal. The goal of the tool is to not impact the client's base expenses. So it's looking to be tax neutral. If there are any tax savings from the contribution, that reduces the amount withdrawn. If there are any tax costs for the withdrawal, then that would be added to the amount taken out. So this is designed to try to make the comparisons between projections as fair as possible. Once the client retires, we can see that the withdrawals from the non-registered account increase. So this is to fund both their spending and the ongoing TFSA contributions. If you hover your mouse over top of the withdrawal value in any year of the plan, you'll be able to see the amount that is being transferred into the TFSA. So in this case, it's $7,500 of this $29,000 withdrawal is going into the tax-free savings account. That process continues all the way down until age 67 once the account is depleted. If we go to Jane's side of the projection, we can see similar information. So we have the TFSA contributions, and then you'll see that she has less money starting in her non-registered account, and so she depletes her non-reg as of age 64. But Snap is using John's non-registered money, and it's transferring TFSA contribution money from John's side to Jane's side, and then that's being used to continue to contribute into the TFSA. So Snap will continue to contribute to each client's TFSA for as long as there are non-registered assets available. Now, this is really all that you need to do in order to take advantage of this tool in the vast majority of your scenarios. However, there are additional capabilities for more advanced planning needs. So I'm going to go to their list of scenarios and go into a detailed scenario that has additional accounts broken out for John. So in this case, he has 2 non-registered accounts and 2 tax-free savings accounts. You'll see he has $150,000 in non-reg 1 and $50,000 in non-reg 2. The way that Snap will work by default is it will prorate withdrawals from the non-registered accounts in order to fund the TFSA contribution. It would also prorate the contributions to TFSAs based off of the starting value in the account. Because there's no current value in this TFSA, all of the money is being allocated to the first account. We can control all of these settings within the software. So for instance, if we don't want it to withdraw proportionally from the 2 accounts, we can go into the financial asset management section, and we can change the CFM method, the way that Snap withdraws from accounts when there are multiple of that account type, from proportional based on value to sequential based on order. And that's going to take all of the money out of the first non-reg until it's fully depleted, and then it would move on to the second non-reg. So now you'll see all of the money comes out of the first account, that continues until it's depleted, and then it moves on to the second account. If I switch back to the proportional, I also can simply override the account in order to prevent Snap from taking money out until a specified time. So if we don't want to take anything out for the first 2 years of the plan, I could override it with zeros, run the scenario, and then Snap is going to pull the full amount from the other non-registered account. Right now, Snap is transferring the full $7,000 a year from their non-reg into their TFSA, but the client might already be making some contributions out of their employment income. So maybe they're contributing $3,000 a year from cash flow, and then they want to do the remaining $4,000 automatically from their non-reg. The way that that would work is you would enter $3,000 into the contribution, copy that down for 2 years, and then Snap is going to transfer the remaining contribution room of $4,000 a year from the non-registered into the second tax-free savings account. So here we have $3,000 overridden to come from cash flow, and then $4,000 automatically coming out of the non-registered account. So there's quite a bit of flexibility, but ultimately, again, if we go back to the simple version, once you turn on the tool, Snap is going to check at the start of each year whether there is cash available in non-registered assets. If there's TFSA contribution room that is not going to be used that year by the client's contributions, it will move the money over at the start of the year, and any growth will be earned in the TFSA instead of in the non-registered account. We're continuing to launch new features to help save time in the optimization process and help you create better plans for your clients. I hope you enjoyed today's video, and I hope you have a great rest of your day.